You've been searching for the best way to generate passive income in your life and heard that real estate is a great way to do it. But you're tired of all the so-called gurus who are all talk and no substance. Get ready to celebrate because Kevin Buck has spent 14 years successfully making it happen. This is the Real Estate Investing for Cash Flow podcast. Now, here's Kevin Buck.
Hey guys, Kevin Buck here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast, where our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. Now, our guest for this week's show is multifamily investment expert Andrew Campbell. Now, Andrew is the founder and managing partner of Wildhorn Capital, a multifamily investment firm focused on buying value-add assets in Central Texas. Today, Wildhorn controls and manages a portfolio of nearly 2,000 units valued at over $200 million. Now, as a native Austinite and a father of four, Andrew is focused on acquisitions and maintaining investor relations at Wildhorn, amongst all the other hats required to build and support a growing business. Now, prior to Andrew's real estate endeavors, his background is in market research and brand strategy, spending time in both advertising agencies and emerging technology consultancies, where he was most recently a partner at award-winning app developer. He received his BS in advertising from the University of Texas at Austin and an MBA from Baylor University. And so with that, I'm super excited to get onto the show with Andrew. But before we do, just have a few quick housekeeping items. Now, the first announcement here is about the ebook that we're giving away for free. This is an ebook about the merits of investing in parking lots and parking garages. Now, guys, as I've said before, this is one of the most misunderstood and undervalued assets in commercial real estate today. And it's just a few of the reasons why we're so excited about this asset class. Anyway, the book is called Parking Lot Profits, and you can download your free copy by going to parkinglotprofits.com or by texting the word parking lot, no spaces there, to 31996. Again, text the word parking lot to 31996 and you can grab your free copy. Moving on here, we just launched a brand new partnership program called Bring Kevin a Deal. And this is where I will pay you as much as $200,000 for any deal that is referred to me that I end up buying. Now, to learn more about this opportunity and to download my deal acquisition criteria guide, you can simply go to bringkevinadeal.com. Again, that's bringkevinadeal.com. Download my acquisition guide, and guys, I look forward to doing a deal together. Let's make some money together. And moving on here, if you love what we're doing here at the Real Estate Investing for Cash Flow podcast, please, if you haven't done so already, subscribe to the show. That way you'll be in the loop of every brand new show that comes your way. In addition, if you haven't done so, please leave a rating and review. It's how we attract awesome guests like Andrew to the show. And lastly, guys, moving on here, before we get on to the show with Andrew, just want to remind you of the free 30-minute phone call I do each and every week. This is where you and I can jump on the phone together and talk shop, okay? It doesn't matter whether you're brand new or a seasoned pro. I've been doing these calls now for 5+ years. It's been a long time. I've talked to hundreds or thousands of you over these 5 years. It's been an awesome time. I've met some really cool, incredible people, and I would love to meet you and hopefully help you on your journey as a real estate investor. And just to clarify, guys, this is not a sales pitch. I'm not going to try to sell you anything. It's just really a way for me to connect with my listeners and to hopefully act as a sounding board and maybe pay it forward and help you out in your business. And so go to kevinbuck.com to get signed up for that call. And now, guys, without further ado, let's get on to the part of the show that you've been waiting for, which is our interview with Andrew Campbell. So here we go. Alrighty, guys, it's my honor to introduce my guest for today's show, a real estate investment expert and founder of Wildhorn Capital, Andrew Campbell. Andrew, how's it going, buddy?
That's great, Kevin. How are you?
I'm doing great, man. Thanks for coming on the show. I was looking forward to having you. And obviously, amidst some crazy times here over the last couple of months. So appreciate you taking some time away from your business and your family to jump on here with us today. And so, let's start off by going, with a little bit of your background, Andrew. For the folks that might not be familiar with you and, your background, but also Wildhorn Capital, your investment group, maybe take a few minutes and tell us a little bit more about yourself and what it is you do.
Sure. Well, I guess I'll start, on the personal side. Live in Austin, Texas. I've got 4 little kids, a great wife, and my kids go from 9 to 6 months. So we're busy on that front. And from a business perspective, we're a multifamily operator focused on Central Texas, so Austin and San Antonio, where I was born and raised, and we've got good relationships and connections, but just kind of fortunate to be from what I think is probably the best market in the country to be investing in. And we've got about a little over 1,800 units that we manage here locally.
Good deal. And how long have you been doing it, Andrew?
As a real estate investor, probably about 12 years. Kind of my path started out. I grew up in Austin. I went to UT. I got an advertising degree. Moved away, San Francisco, Minneapolis. Kind of worked big ad agencies. I moved back to Austin in 2007. My dad had some health problems and kind of came home. Basically, just never left. Stayed here, and that's kind of what got me into real estate. I was looking for passive income, looking to kind of create some flexibility in my time. And so I started buying duplexes and fourplexes. And that was, 2009, 10, 11, which obviously was coming out of the last recession and was great timing. I was doing it in Austin. So built up a pretty big portfolio there, about 75 units, all with my own capital, and realized that I saw the business plan and I saw the returns and I saw the flexibility and all this stuff happening. Wanted to go scale and grow that, and figured, needed to go get bigger properties that were more efficient and be able to raise capital and partner with other people. So kind of made that transition probably 4 or 5 years ago. As Wildhorn, we bought our first deal like 3.5 years ago in San Antonio. And so the 1,800 plus units has kind of all been done in the last sort of 3.5 years.
That's fantastic. That's a lot of growth in a short period of time. And so I would love to talk about the transitionary period. I feel like that's the, getting started is the first struggle that people face, right? That's the first brick wall, is getting that first property, whether it's a single family home or a duplex, what have you. Once you get that first property, you start understanding what works and what doesn't work, and you build some type of systems around it, and you get a business, right? But then when you actually transition that business from, owning, 75, residential units, mostly duplexes or smaller single family type things, to a larger type of asset, 200-300 unit type apartment complex, that itself is a big transition. So if you wouldn't mind, maybe dissect that a little bit, give us a little bit more of that granular look into what that transitionary period looked like and how you jump from one to the other.
Yeah, I mean, I think, goes back to number one, I've got an awesome spouse, and I think as we built the portfolio, I was working a full-time job. By the time I had moved back, or once I moved back to Austin, started investing, I was working also, and I'd gone and got an MBA while I was working. So we had a lot of stuff going on. But I got, I think the portfolio and was really enjoying that and was spending a lot of time doing that. I was managing them myself. I was dropping off air filters every month. I was doing everything, and I think my wife kind of said, look, this is what you love. Like, the other thing's sort of in your way. You're really a miserable person. Like, let's go do this. Let's go do it full time. And at that point I had, heard a little bit about syndication. I don't feel like either I was so new to it, but I feel like there wasn't as many resources at that time out there. So it took some time to kind of figure out, what does that look like? How do you go raise money? Obviously I hadn't done that. And that was my big question. It was like, everything I've done has been with my own capital. I feel like the nuts and bolts of the business, you buy a place, you fix it up, you put a renter in there, you get, they pay their rent. Like, it's simple. I tell people all the time, real estate's not a complicated business. If you have the right systems in place. So I understood that, but it was the getting comfortable with, how do you structurally go raise money, legally, but also like, how do you get people to sort of trust you and have the confidence to go do that? And so that was kind of the big transition point there. I spent time making sure I understood how to do that. And then just, started having those conversations with friends and family, and you kind of grow that network, as far as potential investors, and kind of said, all right, we're going to go all in. And again, with kind of my wife's pushing and blessing, like, hey, we've got 18 months or 2 years. We've got this rental income coming in and savings. Like, let's go see what happens if we go full bore on it.
That's awesome. Good deal. And so during that transitionary period, did you start selling off the smaller properties to use that capital to, parlay into the bigger assets, or how'd that work?
Not initially. I mean, the thought was, hey, we've got the cash flow coming in from those. And I knew that, hey, I could peel them off one at a time if we needed to generate, cap just to live on, right? If we're not successful, we can start to peel them off. We were able to do a couple of deals within the first year. And then I started to transition and sell those off to generate some of the liquidity to, for all the bank requirements on the bigger loans. And then it also just became a distraction. I think it was, hey, this is all my time, energy, and focus, and the responsibility of stewarding everybody's, resources and investment I need to go all in. And so over the next sort of year and a half, we sold kind of in chunks the remaining pieces of our personal portfolio.
Yeah, fantastic. And so I'd love to switch over to Wildhorn Capital. And as you had mentioned, back when you were just getting started in the syndication, or just starting that journey of education into the space, there weren't a lot of resources. I mean, I think that you hit the nail on the head. Now I feel like you could probably go on Amazon and buy at least 20 books on the topic. And back then it was maybe one you could find, right? If you had to dig a little deeper, and it was probably outdated information at that. And so it was kind of it was a country club game back in the day, right? And it was a big boys, the folks that had the rubbing the elbows on a regular basis with folks that had a ton of money. And if you weren't in that network, then you just probably never heard of it, right? You didn't really ever even think of how maybe these larger deals got done, under the premise of a syndication. And so, I want to talk about, you went through the educational stages, you learned the business, and, Wildhorn Capital, right, was formed, and you were looking to take that leap of faith. And, in order to separate yourselves, in order to really put yourselves out there, you got to do something to stand out amongst the masses that are out there. Again, there's a lot of folks out there doing syndication, not just in the multifamily space. I mean, it's not a day you can't get on LinkedIn or Facebook or any other one of the social media platforms and probably at least see a handful of offerings, right? Or someone talking about an offering. And so what do you do uniquely at Wildhorn Capital that sets yourself apart from, again, all the other masses that are out there doing the same thing or similar things?
Yeah, I think two things come to mind. Number one, we've got a very specific focus, sort of with our message and with what we're trying to do. And that is we buy Class B or better assets in Austin and San Antonio, multifamily assets. So we're not trying to be super geographically diversified. We've actually spent time in other markets in the past and felt like, hey, we need to offer geographic diversity, and realized that, hey, we don't have a competitive advantage in Atlanta, for example, where we spend a bunch of time. Like, I'm not from there. I don't know it as well. It's a great market, but it's super competitive. Kind of got our teeth kicked in and retrenched home and said, this is home. It's where we know. It's where we also have competitive advantages, where I know all the brokers, we do play golf with them. We see them at kids swimming events. Like, it's because we're here in the market and we're local. So I think we're very consistent with what we're looking for and kind of our criteria, helps us, get deals and find and keep our ear to the ground on that front. And I think with the investor piece, really focus on our communications. My background, I got an advertising undergrad degree, spent time in ad agencies. I take pride in our communications, in our relationships that we build with, one-on-one connections with investors who a lot of them have become really good friends of mine. And then just our monthly communications to investors, whether that's, a newsletter or, our investor updates, kind of providing a lot of data. Hey, this is your asset as much as it is ours. We're going to tell you the good, the bad, the ugly, and be really transparent. And when we get good feedback on there. So I think those are the two real kind of pillars of what I think we try to do to differentiate, communicate, and just those relationships with investors and brokers. You mentioned a newsletter. Is that something that you guys do on a monthly basis? Yeah, we send a kind of a once a month update newsletter of just, I'll call it a marketing newsletter. We write a couple articles a month. I usually write 2 articles a month, send out, here's some thoughts on the market. Here's, what's happening. Here's some interesting news articles related to, multifamily or Central Texas. So we send that out once a month. And then for every single deal, we do a monthly communication for that group of investors. Got it. Is that in a print format, like the newsletter, or is that an email newsletter? It's an email. Okay. Got it. No, I'd seen something that Joe Fairless, I think that he does an actual physical newsletter. I'm not sure how often he does it, but I thought that was brilliant. Just another level of value given to the investor. So I really like that idea. We'd love to talk about the time we find ourselves in today, right? I mean, I think we're over the hump for the most part of the country. We're on the tail end of this pandemic and coming down the other side. You're in Texas. You're in one of the states that, amongst Florida and Georgia, Texas, the three of us seem to be the ones that were willing to take the leap of faith and open up a little bit sooner than the rest of the country. And it looks like it's going well, right? I mean, it's going better than most had anticipated. And so with that being said, the last 2 months have just been a really strange time. I mean, I don't know how else to say it other than that, just really strange, and lots of adaptation that had to be made as far as,
communication with residents and just shifting of business models and trajectories, what have you. And so I'd love to hear from your perspective, like what are some of the changes that you guys had to put in place? And, of those changes, what are some that you see sticking here moving forward as you guys continue to grow your business?
Yeah, I mean, I think there's obviously a host of topics wrapped up in there, and you look at kind of on site, what are the things that you've done to respond, and which of those pieces do you carry forward? I mean, I think we've worked incredibly closely with our management team and kind of the communications with residents, and sort of preparing for the worst. I mean, if I think you're right, I hope you're right that we're sort of on the tail end of this. You go back and everybody was just losing their mind. I mean, I don't know how many gray hairs I got thinking about April. Collections as this was, oh my gosh, April's, we're gonna lose our deals and you're gonna get 50% collections. And that didn't turn out to be true. I think we wound up like 97% collections. And then it was, well, May is going to be worse than April because we're further in. Well, May, we're going to be at 98%. But I think preparing for that and communicating with residents, obviously everybody's going through a weird time. It's a horrible time if you've been laid off, and there's been a ton of people that have been laid off. So communicating with the residents proactively, here's what we're doing, so the amenities have been shut down. But, more importantly, if you have needs, if you've been laid off, if you're just struggling, tell us, let us help you, let us know. We want to be as flexible as we can, and I think opening up that communication has been really helpful. Something that we've always tried to do with our residents and with our management teams is say, hey, you are not dealing with a massive institution. It's, some big bureaucratic, nameless, faceless thing. Like, you're dealing with Reed and Andrew. We are the owners of this thing. We make the decisions, but we're just two normal guys. And so we know our managers really well, but we also try to have that trickle down to the residents, and we give quick answers if somebody has a request. So I think that's something that we've always tried to do. I definitely think that's something that we, have pushed even harder and will carry that forward. On site. I think with residents or with investors, the communications has been big. Again, kind of even giving more information than we normally give. Here's what collections looks like, where we were last month, how many people are on payment plans, what our debt service coverage ratios are, just trying to show them as much information as possible. So this is where we stand. This is how things are going. And we've gotten really good feedback on that, as we've sort of crested and the panic has subsided a little bit. I think we'll probably dial back some of that info, but still continue to, be very open and honest with our communications, with investors. And, I think it hasn't been a huge shift in our business. We definitely spent a lot of time initially focused in preparing for the worst on the asset management side. It hasn't been that bad. I think now the general feeling, at least in the Central Texas region, is like collections were sort of relatively unaffected in multifamily. Multifamily is weathering the storm far better than the other asset classes. You look at office, collections are like 50 or 60%. Wouldn't
want to be there.
No, and you wouldn't want to be in retail where collections are 35%, and you damn for sure don't want to be in hospitality where they're 10%. So I think we're seeing a sort of somewhat validation of the investing thesis that Class B multifamily is pretty resilient. And I think we're seeing, Central Texas is being, kind of leading the country as far as collections. I saw some data from JLL had about market by market collections. This was on May 10th, I think. And Austin had the highest collections of any city. The nation was at 88% collected multifamily, and we were 92. I think Nashville was 85. I think New York was 62. I mean, there were definitely some laggards in there, but we're performing well, and so I think that gets me. I'm not going to say excited about the future, but more committed to our thesis going forward.
Yeah, no, fantastic. Appreciate the feedback. And as far as your communities themselves, at what stage are they at today? I mean, do you have the common areas back open, the swimming pools and things of that nature?
Yeah, the swimming pools opened up Friday, so kind of along the guidelines for Texas, but just in time for Memorial Day. I think May 1st was kind of the beginning of the reopening in Texas, and, leasing centers were partially open for appointments. Dog parks were open, but, pools, playgrounds were closed. Those are now back open on site. And we're number one, following all the sort of guidelines and working with our management company to make sure we're on par with kind of what's allowed, but then also what's right for our communities, giving residents as much quality of life, but then also trying to monitor and make sure there's not, this big second wave. But so far the feedback's been good. And I think what's encouraging, it's related back to collections, but it's also just, we're all in this together, and I think you're seeing the social contract of residents, even that are struggling and have lost their jobs, are making an effort to pay their rent. They understand, hey, again, we're just two guys. We got to pay the mortgage. We're all in this together. We're going to do everything we can. You're doing what you can. People are wearing their masks. I mean, it's just sort of this idea like this is really uncomfortable for everybody. And it doesn't matter who you are, it's affecting you. And I think that's been unique to this episode.
Yeah, no, I agree with you, and I'd love to get your feedback on, what do you feel some of the long-term behavioral changes might be? Like, I truly think that there would be some major shifts that kind of stick over the long period, but just from what I guess more from like what you're seeing in Texas there, what you're seeing in your communities, like you opened the pools back up. I mean, was there a large influx of folks that didn't seem all that concerned about, obviously what we just dealt with the past 2 months, or were folks very reserved and kind of, you had a few people at the pool and just out in public, but not a large majority, not the normal amount that you would in a normal situation?
Yeah, well, and so to be clear, today's the Wednesday after Memorial Day, so we've been open less than a week, and they opened. We had signups, so it wasn't, hey, all 200 people come on down. Like, it's still kind of have sort of a measured approach. Obviously, we hope that goes away and it's full access to all the amenities on site. I think bigger picture, Texas, you're seeing restaurants are now at 50% capacity. But it's, I don't think most restaurants are full. Outdoor patios are full, but interiors, people are still a little hesitant. My family hasn't been out, to a sit down restaurant, just because I don't know that we're quite comfortable. And there's also some social awkwardness and stigma of like, is it okay to be out and about? Do you need to wear your masks if you're just doing this activity versus another? And it's still rather be safe at this point. So I still think we're a ways out from that. But I think to your question, what's the longer term? I don't know. I mean, I go back to where I'm committed to our thesis. I feel like, the multifamily is going to be pretty resilient and people need a roof over their head. So if there's long-term implications to work from home, that might have implications about people wanting to get a 2-bedroom, when there's just a couple or one person, because they're going to have a home office as the other bedroom. But, does that affect our business day to day? It's still a resident in a unit.
Yeah, no, that's great feedback. And, one of the questions I have, and again, only time will tell. There's no one's got the crystal ball, to tell us exactly what the future looks like. I saw a syndicator, a great guy. But I'm not going to mention a name, put out an opportunity. I think it was about 3 or 4 weeks ago. And, I think it's somewhere in Texas. I don't remember the market, but he's a brilliant marketer, and he was marketing the fact that it didn't have the amenity. It didn't have a swimming pool. It didn't have a clubhouse. It didn't have common areas. And it was I forget how it was spun, but it was a COVID or pandemic appropriate or whatever. Basically, he was pitching the idea that, hey, these social common areas don't exist, and why should they? We don't really need them anymore, right? Be safe in your home and blah, blah, blah. So I thought it was kind of interesting to see that kind of thing, which I don't think that will stick. I don't think people will get sick of swimming pools or will get scared. Again, unless we have another spike, who knows? Unless there's a major spike that the second time around in the fall that's worse than this first go around, and and we're all wrong here by opening things back up. But I personally don't see common areas going away. I personally don't see the gyms going away, or the fitness facilities or swimming pools, what have you. But I thought that was interesting to see him taking a spin on what was going on, and pitching it as a positive. So
yeah, no, it is a good marketing spin.
So what, again, no crystal ball involved here, but what do you think opportunities will come out of this? I mean, not necessarily just multifamily, but what do you foresee as being some of the positives, if there are any, that have come out of this, or that will come out of this? Yeah,
to your point, it's super early. So, are you going to see a bunch of I read an article yesterday. They were talking about, I think it's $300 billion had been raised in the last, couple of 6 weeks by, big groups in New York with dry powder. And that's an insane amount of dry powder looking for distressed assets.
Yeah.
Where do those opportunities come? And you see a lot of people talking about that. All right, here's your opportunity. I've been waiting for it. I don't know where those come from. And I don't know if there's going to be a whole lot of those in the multifamily space. I think, you look at, to your earlier point, interest rates an all-time low, it's very enticing to go get new debt. But as a current owner, we're not seeing a big dip in collections, any dip in collections. So could that happen? And I think now the current narrative is like, well, wait for August and September. Once the government stimulus, unless they extend it, then it's run out and the extra added unemployment benefits end in July. So August and September collections could be rougher. And if that happens, or if there's a second spike, all bets are off. But I don't know that you're going to see a massive amount of multifamily distressed assets come out. We touched on these other asset classes, and I'm not investing in those. I don't have real intention to pivot again. We're pretty focused. So maybe you see some distressed. I'm sure you'll see some distressed hotel opportunities, and probably coming out first. That's not something that we're going to look at or participate with. I think we're pretty dialed in on what we do. I think the thoughts that we have about the multifamily space is that I think if this does play out where we come out of this in the best situation of any asset class, it makes it more enticing. It's more secure. It's more safe. You can point to the data that shows, hey, this is the craziest thing anybody ever lived through, and we weathered this pretty damn well, and our collections were 95+% or whatever the numbers are going to be. That may drive more competition. You might see it go the other way.
I agree.
Folks that were buying other asset classes may flock to this for security. I think our geography again in Central Texas could benefit us if we do, look the best out of all the other markets. If you compare like Orlando or Vegas, some of these hospitality driven markets where a lot of money had been flooded into, probably not, be a little hesitant to go back into those markets. So I think we're kind of preparing more for increased competition and kind of how do we prepare in that vein than we are for some massive, fire sale and distress situation.
I agree with you. Actually, I think that due to the interest rates just being at an all-time low and probably will be for some period of time, I think that what we'll see is more than likely cap rates actually get driven down in multifamily and mobile home parks. I think those two asset classes together, I think that a lot more competition, and that spread game is real. I mean, buyers can actually get a little bit more aggressive based on rates that just came out last week. There's full leverage right around the 3% mark on Fannie debt. I mean, that's just ludicrous. That is a once in a lifetime opportunity in and of itself. And so, again, I think it's going to drive a lot more competition. And I don't think we're going to see the distress in our niches that we're going to see in the others. And so, regarding the hotels, I do think that there will be opportunities. It's not really it's not our vehicle, to go after, but I don't think necessarily just the hotels, but I think that hotels in prime locations that have a high demand for housing, they have a shortage of housing still being converted, into multifamily properties. I do think I see some plays like that coming down the pike as well. And you'd mentioned office, you got I think that's going to be a complete ideological shift as far as, people going back to work, or, companies saying, well, we don't need this much space anymore. I mean, when it comes time to renew this lease in 2 years, we're not going to, or we're going to renew a portion of it, a third of it, a third of that space. And then retail is going to get crushed as well. It is getting crushed. And so, typically office space is slightly less expensive than that of retail in the same, geographical location or geographical region. And so maybe offices say, hey, you know what, instead of not having any type of exposure, now we can actually afford the exposure because this retail center is no longer renting at $50 a square foot. Now it's $20 a square foot, right? I mean, like all these shifts, I think, that are going to occur, and only time will tell how it all really plays out. But, with that being said, again,
do you think that retail, as you were talking about that, as this thought that retail is definitely suffering more than office right now, but will it bounce back more, as some of the needed retail that's always going to be there, those businesses either, come back to life, or the next wave of things come in. But I agree with you on the office front. I think there's some fundamental different shifts in Companies will say, well, I don't need 300,000 feet. I need 150,000 feet going forward. So that may be hit more fundamentally and just philosophically the way people need office space more over the long term, more than retail. Will it bounce back quicker? It got hit harder, but will it come back more V-shaped?
Yeah. What, retail? Is that what you're asking? Will it come back? I don't see how that's even a possibility. I mean, unless you've got retail centers that strictly house, or majority of the folks in, or, the tenants in there are like service based, right? I mean, where you got dry cleaners, you got grocery, you've got, barbershops, things of that nature it's at this point in time, it's impossible for Amazon to figure that one out, right? Until they actually have drones that have, clippers on them that will come to your house and, shave your head in your driveway. I think we're a far time away from that, but we're already seeing the kind of fallout. There's been major retailers. I mean, there's a list of major retailers that were probably already on the cusp of danger, that this pushed them off the cliff. I mean, there's lots of those types of retailers that they'll just not make it back. And I think, some of the other big shifts that have occurred, think about the older demographic in the workplace, the ones that were just very opposed to accept technology and things such as Zoom meetings, right? Now they were forced into it and they realize it's really not that difficult. Think about the older demographic that are so used, right? Their habits are driving to a store where they need something. But now they realize that Amazon's pretty damn cool because it could show up right in your front doorstep, right? I think that those shifts are not going to revert back to the old way. I think it's nearly impossible because everyone strives for convenience, no matter what age you are. And if you don't have to get in your car and go drive, to a shopping center or to a strip center and what have you, waste the gas, deal with traffic, all that, and it can arrive at your door. I don't think that those shifts are going to go back. So anyway, time will tell, but I think retail, I think it's going to be the one that will probably suffer the greatest as far as coming back. Hospitality will. I mean, people are just itching to get out. Right. And it's just a matter of I think the bigger operators are going to be fine in the hospitality industry, depending on where they're at as far as leverage and, what type of debt they have, things of that nature. But I think it's going to be the small and medium sized operators that didn't really plan for that, the 3 or 4 or 5 months or 6 months of downturn, right? I mean, it's already a fairly thin margin business. And so I think those are the ones that will get crushed. But I think the demand for hospitality it's coming back already. I mean, we talked about like Florida and Texas, these states that are already opening up. And I could tell you that I live near the beaches and I just did a bike ride the other morning, which I do a couple days a week down through Clearwater Beach and a couple beaches south of there. And it's packed. It is jam packed. The hotels are full, So in any event, I think that hospitality will come back. It's just going to be the ones that couldn't really hang on. They didn't have the reserves set aside and they don't have the deep enough pocketbooks to hang in there during that period of time. And then office, most office users, they have longer term leases, so I think it will take some time for those to, if they make the decision to take less space, they're going to have to wait until their lease renewal period comes up before they really push for that or make that major change within their business model. So, there might be a lag there as far as office and what the occupancy rates really look like, or how the landlords are truly going to suffer over the long term as lease renewals start playing out in the future. So again, all these things, man, again, it's these last couple of months are not the barometer at all. They're just they're the spark that has set the fire. And a lot of people think now, well, okay, the spark happened and, now we're getting back to normal. But now, man, there's a fire that's raging that's going to play out for a period of time. It's going to take some time to put it out. That's kind of how I feel. I'm not an economist, but that seems logical to me. That's going to take a good bit of time for this all to sort itself out. So,
well, I think you're right. One of the things we've been thinking about and kind of bringing back to multifamily a little bit is the impact of the pandemic is supply. And you look at how many projects have been killed right now, and new construction projects. They can't get financing, and that's been the biggest impact. A lot of sites that were going to happen or going to trade, they just you can't get financing. So what is the impact of that? Well, 2 or 3 years from now, when those projects would be delivering, you're going to have a big gap in 2022, 2023, where there's far fewer units being delivered. And if you are in a market that's been growing like Austin, where supply hasn't kept up, you're going to see even a bigger gap what are the implications for that a couple of years out for now? Because I think that's certainly not a near-term thing, but because I can't get a project started now, or it's going to be delayed 6 or 12 months, you're going to have a window of time in 2 to 3 years where there's not supply being delivered. And, does that drive up rents for a period of time? What's the overall impact? But I think that's the other piece we're thinking about that is sort of pandemic related, and what's a little sort of midterm impact of that.
Well, I think that exact situation played out, post 2008 recession, right? I mean, there was a period of years where there was not new supply coming back on the marketplace, right? And it created this massive void. So, and then the race began, right? The rate, 2012, 13, 14, I mean, like the heat got hotter and hotter. And so I think that you're absolutely right. Again, time will tell. There's so many variables involved here, and I don't think, no one knows the answer, right? Like, it's just all speculation at this point in time and conjecture. But all I can say is that, we've been, really conscious even before the pandemic of, having a lot of liquidity, and, the historical trends will show that at some point in time, there's going to be some type of dip. There will be something that creates pain in the marketplace, right? This played out, many, decades ago, and will play out in the future as well. And, I just want to be prepared for it, right? You mentioned all the dry powder, a lot of the big New York guys, billions upon billions of dollars. That's just ridiculous, But as long as you're ready and you're able to take advantage of even a very small sliver of that here over the coming years, then you'll be able to position yourself well, And that doesn't matter whether you're just getting started or if you're already involved in the space like you and I are, right? I mean, just be prepared and invest intelligently, really, more than anything else.
Yeah.
So. Yep. With that being said, Andrew, I want to make sure that we get this one last part in here before we wrap it up for the day. And I want to talk about, you mentioned beginning your family. I think it's hard enough to take care of 2 growing boys, a 3 and a 6-year-old. And I've got a saint of a wife that kind of manages the household and keeps things somewhat normalized. You've got double that, right? You got double the duty, and so you have just an incredible wife as well that helps hold it all together. But let's talk about balancing. I know that there's always a balancing act, and I actually think it's been a lot easier over the last 2.5 months to handle this balancing act because I haven't been traveling. I haven't been going to networking events or conferences. I mean, I can't. There's probably at least 5 conferences or so that I probably would have been to over the last 2 months that I didn't go to. So I'm home. I'm not stuck at home because I'm a homebody anyway. So I've actually enjoyed it. But talk to me about it on a normal basis. How do you manage the work-life balance and be able to provide adequate focus on the family side, but also provide the necessary focus that your business needs to grow?
Yeah, I mean, it's a challenge for sure. I think it is for anybody. It's also really, I think, a key piece of why I want to get into this business. We talk about life by design. And go back to why I got into real estate investing. Well, is to be able to have some time to help my dad, who still has needs and issues from his stroke. So it's something that's very important to me, and life by design is sort of a mantra. It's on my wall, to the left of me here. Like, how do we construct our days and our weeks and our months where there is that balance? Is a key thing we do. So, I agree with you. I think the last couple of months has been sort of nice, and it's sort of leveled the playing field for everybody. For us. You're not worried about a kid jumping on a Zoom call because it's happening to everybody. Sure. It's something you and I might deal with more on a regular basis. And you're like, oh God, don't let that happen. But now it just happens. So I think that's been a little bit liberating in some ways. I think the big thing for us, it's just time shifting and communicating as much as we can. Every Sunday I sit down and kind of plan my week. Spend an hour really going through what I have going on this week and kind of blending the personal and the work. Obviously, shifting into summer here. Shifting into school ending and kind of losing some of the structure that the kids have had. That always is a sort of inflection point and creates some ripples for a couple weeks. How do we, work doesn't stop. We need to continue to do that. So how do we, get up a little bit earlier, or work when the kids go down, or nap times. But I think it's important to me. It's a priority. And so it's something that we do. And a good example, like today, our daughter's got a dance tryout thing where they're kind of got all this, COVID, you can't go in. And so I'm going to go down and let her go in. I can't go in. I'm going to work in the parking lot and take calls and be on my computer. But I can do that, and my wife will be at home with the others. And having that flexibility is really nice to have. Something that we both don't take for granted. But it's also a big part of kind of what we built this business for. To give us that flexibility.
Yeah, no, I agree with you. And, I think one of the, again, talking about some of the positives that have come out of this pandemic, there's certainly a large amount of, negatives as well. But some of the positives would be those folks that work for a company that never really had that flexibility. They had to work in an office. Now they're seeing that they can be just as efficient at home. They get their work done, which is a huge benefit for the company. There's a huge benefit for them because they get to work at home and have some flexibility with their children. They get to eat lunch with their kids, right? Which before they never had the opportunity of doing that, or just lifestyle by design. Technology definitely is a big assist there as far as allowing us to work where we want to work from, which is a beautiful thing. But no, absolutely, one of the main reasons I got into real estate many years back as well. So we definitely share the same premise there. But Andrew, again, being respectful of your time, just, we're running out of it here. And so I want to get into one last thing here before we get rolling. This is what I call the golden nugget segment. And what I'd love to ask of you is, if you had just one last final golden nugget of advice or wisdom that you could leave with the listeners here today that might inspire and motivate them as they progress in their own real estate investing career, what would that one last golden nugget be?
I mean, it may be a little bit cliche, but I think it's just taking action. Whether you are a passive investor, whether it's active, you're trying to make a transition. I think it's just taking action. My journey started buying a duplex, and I remember, I pulled up to the very first property we bought after we closed on it. Pulled up to it, had a letter in my hand to give the residents, and I was shaking. I was terrified. I was like, "What the hell have I just done? I don't know what I'm doing." 12 years later, or whatever, we've got this, $300 million portfolio or whatever it is. That's fun. And it's because I took action and you did it. So I think that's what all of it comes down to. And it's kind of across life. It's not just investing. Just don't just sit on the sidelines and read about it. At some point, dip your toe in the water. And you'll figure out what you like or what you don't like, and you'll learn from it. You're going to cut your finger some, but it'll heal, and just get moving. Yeah. Don't let life pass you by.
I love it, brother. I love it. So for those that are listening that want to learn more about you and what you got going on, what's the best place to reach you?
Probably, our website, wildhorncap.com. And my email is andrew@wildhorncap.com. We're on, Facebook and all the other places, LinkedIn. But if you send me an email, happy to connect and chat and talk more about investing and what you're seeing with the pandemic. I mean, I think that's where I spend a lot of chunk of my time is just on the phone, talking with people. And I enjoy connecting with people and building those relationships and just hearing, how are people dealing with this? What's their thoughts on it? No one does have a crystal ball, like you and I've said a bunch today, but getting people's input is really valuable, and trying to, learn from others and kind of what they're seeing is something I really enjoy and would welcome the chance to talk to anybody.
Yeah, good stuff, man. Well, Andrew, thank you for coming on, buddy, and wishing you and your family the best as we work through this. And guys, thank you for tuning into this week's show. And until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. You guys take care.
Congratulations! Now you've got more of the best tricks of the trade in building massive amounts of passive income from real estate. For more amazing resources, visit realestateinvestingforcashflow.com. And we'll see you next Monday morning.